Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Get to it. As we keep saying, stocks initially getting a bit hammered, bond yields jumping, with traders slashing their bets for Fed rate cuts this year after data showed a solid jobs market and an increase in consumer inflation expectations. So let's dig into all of it. Our roundtable, Bloomberg News International Economics and Policy Correspondent Michael McKee to my left, and to our right is Bloomberg News rates reporter Michael Mackenzie. Michael McKee, let's start with you first. I want to ask you about today's jobs and UMich sentiment numbers laid out for us and what it says about the U.S. economy.
I always love Jobs Day because Carol bakes cookies and, you know.
No, I don't.
I didn't get any cookies today.
Tim decorates the tree.
It's once a month now.
You must be thinking of a different holiday.
Payrolls were obviously very strong. We have to take it with a little bit of a grain of salt because there's probably some hurricane and strike catch-up in that. And also we had the very late Black Friday, which appears to have delayed the hiring of retail employees because we saw a 27,000 decline in retail in November when normally you'd expect all those people to come on, and we saw 43,000 additional people hired for retailers in December, and also 47,000 hired in the category that includes basically the delivery drivers, the UPS and FedEx people who are bringing you all those packages.
The dudes who deliver it before the porch bandits steal it from my or pirates. Excuse me.
There was good news in there, but there may be some payback next week or next month rather. But the good news for the Fed is that the unemployment rate went down. Massive increase in the household survey in terms of people hired after a big decrease the month before, and everybody said, "Oh, labor market's falling apart," and it's not. That's the bottom line here, which can keep the Fed on the sidelines, which will bring Mike Mackenzie in to explain all the joy that was found in the bond market.
I was listening to, I think, Tim, we're all listening to surveillance this morning when the numbers passed, and it was like, I mean, man, the market reaction was pretty swift, Michael.
Indeed it was. This has been a really tough week for the bond market.
It has,
in
right?
fact, what was interesting about today was longer dated bonds have been selling off the most for much of this week. Mm-hmm. Today is all about the front end because the market's saying, oh, the Fed is really going to go on an extended pause now. We've pushed out the first rate cut for this year from around June. Now we're flirting with the September-October time frame.
It's
We've
amazing.
had Bank of America come out today and say, no, we don't see any more rate cuts now for the cycle. Goldman, Citi pushing it back. So the real problem now is that you've got a series of forces all combining to really hurt bonds because there's nowhere here to hide really, because the front end is going to get whacked because if the economy keeps trundling along at this kind of pace, and you've also got that uncertainty coming from the Trump administration coming in, who they want to keep the economy going, the Fed is also going to have to look at inflation a lot more closely now, and we've got a really important inflation report coming out next Wednesday. So everything's pushing us towards a world where the Fed is basically done. The December expectations for rates, where the Fed rate will be, is now above 4%. So 4% is now your floor. And that means the longer end is still going to sell off. It hasn't sold off as much today, but it sold off a lot this week. And we did test 5% on the 30-year. The 20-year bond is already above 5%. 10s went above 4.75, where everyone had been saying, oh, that's going to be where the buyers turn up. We're not really seeing it.
So 476 on the 10-year right now. Yeah.
So does that mean we get to 5%? Are folks that you talked to, Michael Mackenzie, saying we could see 5% on?
Yes, I think you've got a pretty good chance of that. We'll see. I mean, inflation next week is expected to show the third consecutive monthly rise in the headline rate. So we're not trending in the right way. And then Scott Bessent's going to sit down for the Senate confirmation hearing on Thursday, and everyone in the bond market wants to hear what he's going to say about what's happening in terms of fiscal policy. How do you square this incoming administration's efforts to keep on spending, bring in tax cuts, with being fiscally disciplined? And that's what's got people worried as well.
But you guys keep reminding, both of you do that. Listen, there's a lot that happens, from Fed meeting to Fed meeting, whether it's more reads on inflation, more reads on jobs, and then we'll see, Mike, in reality, what we get out of this administration that ultimately might impact things.
Yeah, when Michael was talking, I was
like, we're all data dependent.
I was thinking, you want to pat the bond traders on the head and go, you guys are so cute. I mean, changing your views like this, and we all know in a couple of weeks it'll all change again, because yes, CPI is very important next week, but after that, the big one is Inauguration Day and the 100 executive orders he's going to put out, and then whatever plans they go through. I think the only safe bet is that we don't know what the Fed is going to be doing this year, and the Fed doesn't know either, and they're very happy to go sit in the shade and wait this out for a little bit, because they don't want to be on the wrong side, slow the economy or goose it too much, given what we don't know about what's going to happen.
So January 29th is the consensus, no move on the 29th, and the idea is the consensus is maybe the next move comes all the way in the fall, late summer?
Well, the consensus for January, you look at the WIRP page, and I think it's written down there, we'd be gobsmacked if the...
Let's see, WIRP.
If the Fed moved rates...
Oh, it does say that, yeah.
29th. But after that, who knows? I mean, by March, first of all, we've got the debt ceiling hanging over everybody's head. We're going to have the government has to be funded by March.
Right.
And so
that little thing.
Just those two little things alone, let alone any new policies to throw people out of the country or impose tariffs or things like that.
I want to throw two things into it. First of all, isn't it great that the job market's doing well and this growth is happening?
Yeah.
So where's that aspect of it? The other thing is, and I heard this on Surveillance this morning, like, what is really behind the growth in rates? Is it inflation? Is it that the economy is growing? Like, do we really know what is truly behind the move up in rates?
It's a combination of factors, but clearly if you look at term premium measures from the New York Fed model, it's risen a lot. I mean, it was barely above zero a month ago. It's now above 60 basis points. So it's moved a lot. And that tells you that investors are going to demand a higher premium to own longer dated debt.
Right.
You've then got the front end of the curve where everybody was really telling me for the last month, oh, just stay in the 2-year. That's going to be fine because the Fed's still going to cut this year. Well, now that's now kind of in question. And in fact, we now have a situation that's quite rare. The 2-year yield is now above the Fed funds effective rate of 4.33. Now, before everyone say, oh, the Fed effective is a really tough level to break for the 2-year. Well, that's just been broken. So you're in an environment right now where there's a lot of uncertainty.
So is it uncertainty that's just moving rates up? Like, that's what I'm trying to get to. Do we really understand why we've seen this big move up? Well, I think
there's another element to this and if you talk to I was talking to Greg Peters at PGIM earlier this week, he says, we're just going back to where we were before the financial crisis. That's when real yields were above 2%. Inflation is running in a sort of 2.5-3% zip code, which means bond yields are going to be at 5%.
So back to normal.
That's kind of back to normal.
Back to the old normal.
The old normal.
Instead of the new normal. But what's funny is you look at the actual cost of borrowing, not the Fed funds rate because you're not a bank. But if you look at mortgage rates and if you look at credit card rates and you look at the prime rate for the best business borrowers, none of them have come down. Right. Since the Fed cut rates 100 basis points. And yet the economy, as Michael said, is just still roaring along, which tells you, A, that the Fed's probably not restrictive enough, and B, that the neutral rate has clearly moved up at this point. Now, the Fed's big concern is how long does it stay up? Do we revert? Or are we back at the old normal? And it stays that way.
Mike, when it comes to the estimate, economists, apart from our own Anna Wong here at Bloomberg Economics, they got this wrong in terms of the figure that we got this morning. Why is that so hard to get?
Well, there's a lot of moving parts in all of this, and then there's some groupthink too. And so people are looking at what's happened in the past and extrapolating that. Some people may have missed the change in the holiday and the seasonal effect of that. And it's been for months and months really hard to get a handle on what's happening with the labor market. Remember, it was only a couple of months ago that the labor market was so bad that we had to start cutting interest rates to save it. And now you've got this reversal. And does that last? Or is this just a quickie thing, too?
Like, just to kind of wrap up here, though. So Michael, is that it? Like, we just have to think about folks. We're just going back to the way it maybe used to be, it should be.
I think you have to, because let's face it, so many people in this country have locked in very low mortgage costs. So even though the 30-year fix today is going to be above 7% when we get the new numbers next week, it doesn't really affect the majority of people. And as long as the job market stays tight, and potentially could even be tight if you start to see people being deported this year, if you don't lose your job and you've locked in really low borrowing rates, and look, a lot of companies did the same as well, and we still have all the fiscal stimulus from the Biden administration still flowing through the economy. So again, it's very hard to see what's going to knock this economy off course. The only silver lining for the bond market right now, and the only reason you'd be buying 10-year yields at these levels and 30s at 5%, is that if you think there's going to be enough, we're moving into sort of an environment where good economic news becomes bad news for the equity market, and you get a tumble in stocks, and you get a backup in credit, then treasuries will probably show some haven support. But again, it's going to be interesting to see how that works, given, again, the U.S. fiscal position.
Mike, 20 seconds left here, though. I mean, is there enough growth out there in the U.S. economy to keep things going?
Appears to be that way now, and it looks like maybe only something that would come from the administration at this point, or some exogenous event, some war we didn't anticipate or something, would knock it off its pins at the moment.
All right, cookies and Christmas tree next time around. All right, guys, thank you so much. Bloomberg News international economics and policy correspondent Michael McKee, along with Bloomberg News rates reporter Michael Mackenzie. Guys, thanks. Have a great weekend.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Our next guest has spent a decade and a half of public service serving 3 U.S. administrations, including former presidents Jimmy Carter and Bill Clinton. Joining us right now is Stuart Eizenstat. He's former Deputy Secretary of the Treasury, Undersecretary of State for Economic Affairs, former Undersecretary of Commerce for International Trade, and former U.S. Ambassador to the European Union. He understands a lot of how the world works, certainly from a U.S. perspective when it comes to policy and geopolitics and more. He was President Jimmy Carter's chief White House domestic policy advisor and wrote a biography of him entitled President Carter, The White House Years, and gave a eulogy at the state funeral yesterday for former President Carter. Today, Ambassador Eizenstat is senior council member at Covington and Burling, and he joins us from Washington, D.C. Ambassador Eizenstat, thank you so much for being with us, and we are very sorry for your loss.
Thank you very much. I have known Jimmy Carter for 55 years. I was his policy director when he ran for governor of Georgia, then when he ran for president, and then 4 years in the White House as his chief domestic advisor. So it was a personal loss, but he lived a long life, and he in many ways taught us how to live a life of purpose, a life of faith, a life of determination, of honesty. And one of the things that I really tried to stress in my eulogy was that we shouldn't only look at him as the greatest former president, which he was, 43 years, curing 2 African diseases, monitoring over 100 elections, building houses for habitat. Rather, we should lay to rest the myth that his greatest achievements came only as former president. And I believe that as we look back at what was actually accomplished, that we will see that he was one of the most consequential one-term presidents in American history. And I say that I wasn't nominating him for Mount Rushmore, but he belongs in the foothills with other presidents who have really made the country stronger and the world safer, and he did. And I tried to lay out in my eulogy what major things he had accomplished.
You know, maybe not Mount Rushmore, but you did call him a Renaissance man for all these different things that he had done. You mentioned that in your eulogy. I want to say that I'm glad you went there in terms of his first term or his only term in terms of what he accomplished, because I do feel like so much of the narrative and conversation since his passing about is all that he achieved once he left. But it's remarkable. And in listening to the eulogies yesterday, yours and others, about the issues that he worked on in the White House, whether it was the Middle East, whether it was inequalities, whether it was the environment, these are things that are with us today and pressing and challenging issues. And I think about the environment, and here we are watching the fires out on the West Coast. I want to kind of go there, because obviously this was something that President Carter thought about. What is wrong, and why hasn't our U.S. policy maybe on the environment and climate change specifically, why aren't we maybe better and
well, he
haven't
was,
improved
I
the
think, the
situation?
greatest environmental president since Theodore Roosevelt. He literally doubled the size of our national park system with the Alaska Lands Bill. He had strong amendments to the Clean Air and Clean Water Act. But interestingly, he did the Superfund to clean up chemical waste.
Right.
And all of these are major accomplishments. And in fact, we put out a report in 1980 called the Global 2000 Report, which forecast climate change. He on energy really did everything together. He deregulated oil and gas, that is, ended the price controls, which led to a huge upsurge in production. So we're now the #1 producer in the world of both. But he also had the first incentives for conservation, like insulation, and the first incentives for renewable energy, like solar, and even put symbolically solar panels on the White House. I mean, this was done like in the 1978, 79 period. So he already envisioned that as being a really critical thing for the United States. He really inaugurated the whole clean, renewable energy era.
Ambassador, you talk about all his accomplishments, and look, I think it's important for us to look at historical context here. Why then do you think this didn't resonate with voters, and he lost in the election of 1980 so badly to Ronald Reagan?
That's a good question, and all the op-eds that I've written on his life in the Wall Street Journal and elsewhere, I mentioned that. And I hope we don't end, by the way, before going to deregulation, which even Senator Graham, a Republican senator, said transformed the whole U.S. economy. But let me answer your direct question. I call it the 3 I's that were against him. First, inter-party warfare with the liberal wing of the Democratic Party, headed by Ted Kennedy. It divided the convention in 1980. Kennedy never really reconciled and worked for him, and that was a huge disability. Second, the second I is inflation. We had inherited high inflation. It was part of the 1970s with Nixon, who had double-digit inflation, and Ford, and we had double-digit inflation. But that was largely powered, as was Nixon's, by the way, by the oil shock. It was the OPEC embargo against the U.S. in 1973. It was the Iranian revolution and shock in 1979, 1980 that just hugely increased the pressures. But here is one of the most courageous things he did. Mm-hmm. And it makes the point that much of what he accomplished only blossomed after he left. So let's put ourselves in July of 1979. Inflation is roaring. Gas prices are going up. Gas lines are occurring. And he decides, over the objection, and I'm not exaggerating, of all of his advisors, to appoint Paul Volcker to head the Federal Reserve, knowing in advance, because Paul told him in the Oval Office, that if I'm appointed the head of the Fed, I'm going to have to take drastic actions on interest rates that are going to make it very difficult for you in an election year in 1980 in terms of a potential recession, higher unemployment. And he said, Paul, I cannot make my legacy leaving this kind of inflation. You take care of the economy, I'll take care of the politics. Well, the fact is, inflation dropped like a rock because of Paul's, but only in Reagan's first 2 years after Carter had already left. And third is Iran. The Iran hostage crisis, 444 days, was so unbelievably debilitating and humiliating. Carter made a choice early on that he was going to save the lives of the hostages rather than take dramatic military action, which would risk their lives. All of them did come back. All of them came back safe. But he paid a huge political price for it.
Well, Ambassador Eizenstat, one of the things I think someone said during one of the eulogies is that he was farsighted. In other words, he thought about longer-term impact, not on only the current generation, but generations to come. We only have unfortunately, about 3.5 minutes or so left here. And I do think about policies today that he seemed to have some insight, some foresight, some farsightedness, whether it was the Middle East, whether it was China, whether it was equality in the environment. When you look at the divisiveness today and the political swings that we are seeing and extremes, Americans are looking for something else, and maybe they don't feel represented. How do you think about the environment today? President Carter tried to represent everybody.
Let me give you 3 answers to that. First of all, we had much more bipartisanship then. Much of our legislation, and we had almost 70% of our legislation passed. We had regular meetings with Republican leadership, regular breakfasts, as well as Democratic. Second, he had a major role in ending the Cold War. Mm-hmm. Reagan gets the credit for it, and he deserves credit, but all the weapons systems which Reagan implemented, the MX mobile missile, the cruise missile, the stealth bomber, intermediate nuclear forces in Europe, every single one of them, he started. And though Brennan, the longtime Soviet ambassador in his memoirs, said that Jimmy Carter's human rights policy played a major role in undermining the Soviet Union. And last, he said, I'm going to do the right thing regardless of politics. And let's take deregulation, which would be an important subject for Bloomberg. When we came into office, there was tight regulation on routes and prices for all of our surface and air transportation. Mm-hmm. No new entrants, rigid prices administered by government agencies. Jimmy Carter deregulated every single one of those. Deregulated airlines, which made it possible for competitors to come in.
Right.
Today, 90% of the public flies, only less than 50% did then. Trucks and rail deregulation made a more efficient supply chain. Deregulation of telecommunications allowed the cable era to occur, he even deregulated beer industry, which led to the growth of craft beers.
Here on a Friday, beer industry. I'm in on that. Hey, listen, we only do have about 35, 40 seconds, so forgive me for asking you to be brief if you could. But I do think about those major initiatives that you are laying out as you talk about the former president's legacy. 30 seconds. Do you think the country is moving in the right direction when it comes to laying out those long-term plans? And again, I just ask that you be very brief.
I do not. I think we're very short-term focused. I don't think we're looking around the corner at the real challenges of climate change, the real challenges that will come from China and how to combat it. So I really think we're looking at a very short-sighted, narrow political way of attacking these problems, and we're doing it without the bipartisanship that Jimmy Carter was able to foster.
I so appreciate that, and I so appreciate you reminding us of all the things that happened during the Carter administration. I think history always teaches us, right? The things that go right, the things that go wrong, but it's an important way in terms of our way forward. Ambassador Eizenstat, thank you so much. Stuart Eizenstat, former U.S. ambassador, and so much more in terms of his public service, currently at Covington and Burling.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Gave you an update on the wildfires out there in the Los Angeles area, looking at it from a couple different perspectives on the ground and what we are seeing, but also, we do think about the business and financial impact. In the meantime, you continue to see a lot of organizations that are rallying to help out those affected by the LA wildfires, including some to help find shelter. So let's get into what Airbnb.org is doing. Their executive director, Christoph Gorder, is with us. He joins us from Salt Lake City. Christoph, nice to have you here with us. First of all, what can you tell us about what you are hearing about operations there, your teams in the area when it comes to the fires?
Great. Thanks for having me on. And, our hearts go out to the thousands of families that are just going through the most traumatic events right now. Airbnb.org, we're a nonprofit. We were founded by Airbnb a few years ago, and we provide free housing in times of crisis like this. So we've been working in LA since the fire started on Tuesday, housed our first guest yesterday, and now I think we're probably, the last numbers I have are we've provided housing support to about 6,500 people.
Wow.
In the last 24 hours, but the need is just enormous.
How does that housing support manifest, and what's the relationship that you have currently with Airbnb? Are you taking Airbnbs that are available and then essentially fronting the cost, covering the cost for those affected?
Exactly. So the way we work is we partner with a local nonprofit. In this case, it's a nonprofit called LA 211, which covers all of LA City and LA County. They are very connected into the community. They identify and vet the families who are going to stay with us. Once they've approved them, we issue them a credit to book the Airbnb that works best for them and their needs, where they want to be, if they need wheelchair accessibility or it needs to be pet friendly. And so they're able to just sort of pick the Airbnb that's going to be most convenient for them. And then we work with hosts to get a discount on that, and the balance is paid for by Airbnb.org.
You said about 6,500 people you've already helped out, but you said the demand is incredible. Can you give us an idea of how many people are reaching out and looking for your assistance?
So it's really fast moving. I mean, the 6,500 number is from last night, and I'm just waiting for some updates today. But we'll be thousands more will have gotten help just this morning. In terms of the need, immediately right after we opened the program on Wednesday, we had thousands and thousands of requests, and so we've got a backlog right now, and we're working our way through it. But the situation is still evolving, and there are more areas, opening up for evacuation, and so it's still, I think, unfortunately, very early days. Mm-hmm. So it's hard to get a number really nailed down because it's moving so fast.
One thing that I'm trying to understand is how long some of these folks are going to be displaced. I mean, think about it from the perspective of how long it takes to rebuild something, factor in not just the insurance issues, but also the fact that getting building materials and folks to actually do that work, those people are going to be in a very short supply because of the scale of this devastation. How long do you plan to be housing people in the wake of this disaster?
Well, we've committed, in this immediate emergency, we've committed, and Airbnb is there to support us, to provide emergency housing to 25,000 people. And so we're going to do as much as we can. We sort of look at this in a couple phases as this evolves. The first phase is the evacuation phase, and there the stays that we're providing are very short. So it's about a week. Now, most of the people we're hoping are going to be able to go back to their homes in these evacuation areas, but of course there are going to be thousands and thousands of people who are going to need a long-term stay. And so then we'll move into phase two. We'll extend the stay out to about a month, and we're sort of an emergency stopgap while people figure out their other options. So think of us sort of like as the ambulance that gets you to the hospital, and then there'll be other options, FEMA, insurance, et cetera, that people will need to do, but it's a long, long road to recovery.
Yeah, we can only imagine. Christoph, you guys have been doing this before, in other either natural disasters. Tell us about, kind of what you guys have learned about this process to where you are today.
Well, the idea has been around for a while. It goes back to actually 2012 when Hurricane Sandy hit New York City, and there was an Airbnb host in Brooklyn who called in and said, hey, I see all these people displaced. Can I open up my home for free? And that's where the idea started. And very quickly, there were over 1,000 hosts in New York City who opened up their homes for Hurricane Sandy victims. And that went along for a few years. But by 2020, we realized it was a really big idea. And so Airbnb.org was formalized. It was created as a separate nonprofit. And now we respond around the world to disasters. So Unfortunately in Southern California, we were just down in that same area in December in Malibu, working on a fire there. And it's continuous for us around the world and throughout the year.
Before you go, just got about 20 seconds, 30 seconds. How can people find out more information about this organization?
Hop on our website, Airbnb.org. There's 2 ways you can help. If you make a donation, every penny will go to pay for a family in need for a stay, because Airbnb covers all of our operating expenses. So if you want to help people in LA, it's a great direct way to do that. You'll help us help more people. If you're in the LA area and you've got a place that you can host a family, you can learn about how to sign up to host, and we also need your help there. So,
and if somebody needs a place to stay, how do they do that, real quickly?
So you reach out to 211, LA 211, either on their website or call them. There's a very easy intake form, and they'll take you through the process. There's a little bit of a delay right now because we've got so many people in the system, but be patient, we'll help you.
Good luck with your efforts. Christoph, thank you so much. Christoph Gorder joining us, Executive Director at Airbnb.org.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Carol, the fire affecting so many. Case in point, we were actually set to interview Corey Clipston, the CEO at Swan Bitcoin, about crypto, but he let us know a little earlier today that he now has to evacuate due to fires in Southern California, so he's unable to make the interview.
Right. Joining us instead is John Haar. He's Swan Bitcoin's managing director. Swan Bitcoin, in case you don't remember, it's a platform that offers a host of services, including allowing people to buy Bitcoin in personal, business, and retirement accounts. John joining us from New York City. John, first of all, thank you for jumping in and talking with us. First up, Corey, okay? What do we know about any of your team that maybe had exposure to the LA wildfires?
Yeah, great to be here with you guys and standing in for Corey. So far, Corey and his family and his house appear to be okay, but he is quite close to the danger zone, and I believe he is helping some people who may have lost their home or at least had to evacuate. So it's pretty hectic over there right now, and it's one of those things where every day brings new updates. So yeah, definitely thinking about Corey and all of my other colleagues and everyone who is in that area right now.
It's hard to transition to talking about something like crypto when we spent so much time talking about the wildfires and the devastation out in LA affecting so many people. But nonetheless, we are going to do that because it is one area of green today in a market where we're seeing a lot of selling. Bitcoin up by 3% right now, though it's down about 11% from that all-time high last month, down this week by a little more than 4%. John, what's the outlook as we head into the new year, especially as we get the new administration in office? What's priced in right now?
Yeah, and today is an interesting day. I agree with you. To see Bitcoin be up a few percent while stocks are down, while bond yields are up, that's interesting. I don't want to read too much into one day, but it is noteworthy. Looking forward, outlook-wise, I typically highlight 3 things that I think will support Bitcoin's price going forward. One is continued relatively easy fiscal policy. Number 2 is continued relatively easy monetary policy. And then third is continued adoption. And if we double click on that adoption, I would say it's going to come from many places, but there's 2 big ones. One is potential nation state adoption. And here, of course, I'm talking about a new administration, Trump administration coming in. They're talking about what's being known as the SBR, Strategic Bitcoin Reserve. Some are calling it a stockpile, but either way, it would be the US government proactively and consciously adding and holding Bitcoin, which would be a big deal. And then the other leg of that adoption story is basically what MicroStrategy is doing, and it's corporate adoption. And they have bought just a ton of Bitcoin in the past several months here, and the pace of their accumulation is really increasing. I don't believe we're going to see MicroStrategy, they're in a class of their own, but I think it is going to be a big story for 2025. What nation states do, primarily driven by the US in terms of Bitcoin accumulation, and what corporations do, call it copycats of the MicroStrategy playbook. We're actually calling it LBE at Swan, or leveraged Bitcoin equity. It's a little bit of a nod to the old LBO, leveraged buyout. But that's what we're calling the MicroStrategy playbook, the LBE playbook. And I think there's going to be more companies that do that.
Can I just say, John, I'm listening to you, and some might say, and I'm waiting for the emails to come in, that both of those, forgive me, are maybe a little flimsy. First of all, I think the strategic reserves, I don't know. It's a long ways to get that. And I think there are a lot of folks that say that makes absolutely no sense.
Including some prominent Bitcoin investors like Nick Carter of Castle Island, who came on our show and got a lot of flack for saying he doesn't think the U.S. should do that.
Right. And I mean, as taxpayers, I think a lot of us would be like, wait, what is our money being used for? And the other hand is the MicroStrategy. I get that supply-demand equation and why that is supportive of Bitcoin. But again, it doesn't go to what is Bitcoin? What is it really being used for? What is that long-term usage that, to me, really then would help put in a floor that lasts around for a long time?
Yeah, it's great points you guys bring up. And I am familiar with Nick Carter's views. I think his views were nuanced. He was particularly against Bitcoin being accumulated by a state government, particularly the U.S., using the word reserve and the language that some people were using, that it would be a monetary asset, that it would somehow back the dollar, provide stability to the dollar. That is specifically what Nick was against. And he, in his article, he said that he's okay with a Bitcoin stockpile. So he made that distinction. My summary view is that regardless of what they call it, it's going to act like a stockpile. Even if they call it a reserve, I don't think we are anywhere close to a world where Bitcoin held by the US government is actually backing the dollar or providing stability to the dollar. So I guess you could say I kind of understand Nick's argument. But I think there is a world where the U.S. owns Bitcoin as a stockpiled asset. And I think there is a relatively easy way for them to do that. And that's just them saying, hey, the roughly 200,000 Bitcoin that we hold, we're just going to hold on to it. And personally, I think that would be massive if the wealthiest, most powerful country in the world says, hey, we are accumulating we're just holding a Bitcoin as a strategic asset.
Maybe we need to tackle our deficit first before we start doing that and spending money on it. I guess my point is, I'm trying to understand, like, if that doesn't happen, you pull the rug out, that doesn't happen. If MicroStrategy starts to back off, what fundamentally is there to support Bitcoin?
Yeah, so the MicroStrategy piece, I would say Bitcoin is the primary use case for Bitcoin is a store of value monetary asset. That is distinct from Bitcoin being used as payments or medium of exchange. I think all of that will come, but that's many years down the road. So I think corporations, individuals, nation states, financial advisors, family offices will continue to use Bitcoin as a store of value monetary asset in 2025 and beyond. I think that is ultimately what provides some sort of stability or a floor for Bitcoin, but I actually think it will be pretty significant appreciation in the coming 12 months.
Appreciation is certainly helpful when folks are long Bitcoin or they're making leveraged bets on Bitcoin, such as Michael Saylor at MicroStrategy. But if we see a significant decline, then it starts to really hurt and be painful. What happens then?
Yeah, that's for sure true. If you're going to execute this MicroStrategy playbook, or the LBE playbook as we're calling it, it does require that Bitcoin goes up on a longer term time horizon. I would point people to 2020 when Saylor and MicroStrategy made their first buys. Bitcoin did not go up right after that. It actually went down very quickly in the weeks after his purchases. But the way you execute that strategy is you do it prudently. If you're going to do it with debt, you do it with debt that doesn't have a maturity for 4 to 5 years. If you're going to do it with equity, you tap the equity markets when your stock is trading at a hefty multiple to your Bitcoin holdings. Those are just some of the ways. And you think about the ratio of the outstanding debt you have to your Bitcoin market value. So I think as long as people are doing that, those companies will be okay.
Gotta run. John, thank you so much for jumping in. Really appreciate this. John Haar, he's Swan Bitcoin's managing director.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on.
Excuse me, I want to drive.
The It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 19 minutes to go until we wrap up the trading day. Charlie and Bill Maloney there breaking down the trade on this Friday. And we are definitely off our best levels of the session, but we've seen some definite reaction to the day's economic news, expectations about the Fed, and maybe pushing out, at least based on what we see in the trade, the first rate cut not until maybe October. So, but a lot can happen.
Hey, so what a parlor game we play.
We do indeed, don't we?
I mean, it's like
day to day, week to week,
day to day, week to week. Everything's different when it comes to what investors think the Fed's going to do.
Yeah, I know. It's kind of like, why do we even bother? Because the Fed's going to do what it's going to do when it meets.
Mike McKee pretty much laughed at me when I asked if January was in play.
It's like, Tim Stenovec. No, I know, but you never know. Like,
I mean, look what happened last month.
Things happen, right? I mean, if anything, we found in our year ahead pieces. I think about talking with Tim O'Brien from our opinion team, who oversees that. Sam Potter on the markets and stocks team. Is that there's just so many things in last year that we just weren't kind of expecting, and that happened. So things come out of anywhere. So that will change the market environment.
Well, let's see what Dana Dioria has to say about that. Dana's the co-chief investment officer over at Envestnet. It's the tech provider to banks and registered investment advisors. The investment platform has more than $6.8 trillion in assets on it, managed by many different folks out there. Dana, good to have you with us. How are you?
Good to be here. I'm great. Thank you.
So what do you make of the way that this jobs report changes the outlook for the Fed this year?
Well, certainly predictable how the reaction to it. I mean, it really was a blowout report. This was not, just a little bit more in terms of the non-farm payrolls. This was pretty much 100,000 more than what was expected. So not surprising that the reaction that the market had. Interesting, I guess, from the standpoint that the market had already, of course, from the last FOMC meeting, been pricing, lower expectations for rate cuts. And, those lower expectations, I think, to a certain extent, you could argue we're already sort of taking account of the fact that unemployment was still low, jobs market was still strong, and that the Fed certainly didn't have to move anytime soon. So I could argue this is a bit of an overshoot, that you had the information you had before. We were down to 50 basis points. Now, the market reacts again, whereas this report, blowout as it is, I think is, kind of confirmation of what maybe we knew was a possibility, which is that the Fed really isn't going to want to move. I think we all know the Fed at this point, the failure here is letting inflation take hold again. And so they're probably going to err. I think we all kind of recognize, right, to a certain extent, they're going to err on the side of staying higher for longer. This just kind of, confirms it.
Hey, what does it mean, though, for valuations currently on the equity side of things? I mean, if I look at the price to earnings, so just doing really basic on something like the NASDAQ 100, it's about 32. If I look at it on the S&P 500, it's just about 24. So if we are indeed going to live in this higher rate environment, valuations, they've got to come down.
Yeah, look, 100%, right? Multiples, work inversely. So if you have higher rates, you would expect multiples to come down. And we're already, as you just quoted, we're pretty high on multiples, right? I mean, if there's, a flying the ointment around the expectation that equities do well this year, it's where we sit from a multiples perspective. We have a very concentrated market. We have, a series of very large stocks that are, you just read it, right? Very high. The S&P 500 is very high, and that's driven even more by, kind of bigger names. So valuations do matter. I mean, I'm certainly of the school that you can't keep ignoring that forever. And, higher rates does work against price multiples being a continued driver of expansion in the market. So that's 100% fly in the ointment.
If U.S. stocks are expensive by some measures, by many measures, I think it's fair to say, is it time to look to emerging markets, to Europe?
Yeah, look, I mean, from a tactical perspective, if I was going to look right now at what we see in the market in terms of a strong dollar expectation, a Fed that's not going to cut rates as fast as maybe overseas economies will more likely cut rates more quickly. that strong dollar is a headwind to the emerging market story for sure. So if you're thinking about it in terms of, hey, tactically, what do I think is the case? I mean, I think you have to include that, and you have to, think about within emerging markets maybe where you want to be. But if you're looking at it where I think your question is, and it's a very valid one, which is, hey, look, at the end of the day, the market is valuing all those things. That they've priced in everything that I just said, and having some diversification in that portfolio, particularly when the U.S. market is so concentrated, probably makes sense, particularly for long-term investors.
How do you define diversification then?
So it's interesting you say that, right? If you look at the academic research, theoretically, the most diversified portfolio is the total market, right? It's the market clearing portfolio. It's everything you can own. But if you look at the total market, that's pricing everything at the value in the market, and you're getting back to that place where, okay, but I've got by other measures, I've got some concentration risk there because I've got a lot of money. If I'm sitting in market or anything that's low tracking error to market, I've got a lot of money in those big stocks. And so I think, if you're thinking about it from that perspective, think about diversifying into smaller parts of the market. Think about diversifying, as you said, into international economies.
Okay, international economies, one area we could look. Private markets, though, for retail investors, something that's on your radar. Yeah. I know that the private equity folks would like more people to be investing in the private markets. But
what?
Yeah, more money out there. They want it in the 401k too. Yeah. Is this something that you could see moving away from the ultra high net worth folks and actually going to regular people?
Yeah, for sure. It's very much a trend. We expect the trend to pick up.
Is it a good trend?
I think it can be. Yes, I think it absolutely can be, because you're seeing a lot of the innovation that maybe was available in public markets now take place in private markets. And, if you're a believer in democratizing those types of those return streams, then yes. The devil in the details, of course, is what is the vehicle? Am I really getting access to these returns? And can I live with the illiquidity that comes with it? But I think the alternatives managers are seeing that. They're looking at, hey, DB plans are just not going to be the source anymore. It's all DC. How do we come down market to more of a retail audience? And they're innovating in their structures, interval funds in particular, right? So semi-liquid structures that are maybe more palatable to the audience in that high net worth, and even, getting into the mass affluent area.
Hey, we got to run. Happy New Year. Good to check in with you. Dana Dioria, she's Chief Investment Officer of Envestnet. It's a tech provider to banks and RIAs. The platform has more than $6.8 trillion in assets.
This is the Bloomberg Business Week podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.